Welcome to Better Returns, where you will learn how to escape the volatility of the stock market by passively investing in real estate like a pro. 90% of millionaires earned and maintain their wealth by investing in real estate. We will share real-life examples from savvy investors so you can do the same. He started working at his family's drugstore at the age of 9, and by 12, he was running the cash register. Your host and my dad, Matt Hansen.
Well, I'd like to welcome to the show Rachel and Dylan Grunn. They are co-founders of Third Coast Capital, which is an innovative investment company offering passive investors the opportunity to become co-owners in large multifamily deals. From Airbnbs to mobile home parks to new development, commercial real estate funds, Rachel and Dylan have done it all. But multifamily continues to be their very favorite asset class in their portfolio. So happy to have you both on the show today. Welcome.
Thank you for having us, Matt.
We're excited as well.
Well, tell us a little bit about how you guys got started in multifamily, and then a little bit more about, passively investing that you've done.
Yeah, so I come from a multifamily real estate investing background. My family grew up in the real estate industry, so growing up, I was homeschooled. And so instead of going to calculus, we were going to flips with my mom and my dad. So they started in the, beating the pavement and the single family residential type stuff, which, a lot of people do because they don't know there's a better way. So it wasn't until about 7 years ago that my mom discovered passive multifamily investing. Is a word of mouth thing. As you know, and maybe your listeners know, there's not much advertising that goes on in this space. So a lot of people find out about it through word of mouth. And luckily my mom did. And that was 7 years ago. I invested in my first passive deal in 2015, 7 years ago. And that was awesome and exciting. And after I started to see that return come back in through the mailbox money and the cash on cash, I was totally hooked. And I was like, okay, that's it. Liquidating all of the single family assets. My mom did the same thing. She cashed out her 401k, took the hit, invested it in multifamily real estate, like totally all in. And it has paid off huge dividends. My mom has gone full cycle on almost 20 deals so far in just 7 years. Yeah.
That is
amazing.
incredible.
Sorry, you want to?
Yeah, go ahead, Dylan.
Oh, no, so I was also homeschooled, but I was not taken to flips as a kid or anything like that, or, I was enjoying my life. No, I'm kidding.
Being a kid.
I was being a kid. But I actually didn't really know anything about, the multifamily world or passive investment world until meeting Rachel and pretty much meeting her family as well and hearing her mom's story. I had a pretty good understanding of stocks and mutual funds and 401ks and all of that, but didn't really understand that there was certainly another path you could take that was a lot more lucrative in a shorter amount of time instead of, even just having an employer match your
contributions.
Contributions to your
Right.
401k seemed like, wow, this is amazing. Yeah, someone's going to give me the same thing I'm putting in. That seems like the best thing you could possibly exist. But I was obviously very uninformed, and I'm glad that she certainly turned me on to it. It's definitely it's an interesting path to go down, for sure.
And I just love the fact that, again, you have age on your side. To be that young and discover this, Rachel, is really wonderful that your parents brought you into this and they've done so much. 20 deals. I don't know that many people that have been invested in that many deals. That's impressive alone.
Oh, yeah.
And then so you get to learn from all of her experience, and she's passing down, okay, here's what you need to look for. So in the passive investors she's investing, I know she invests with, because the same people we like. Think multifamily. We'll just say it.
Yeah.
So what is the criteria that she shared with you and you follow? Like when you're looking for a deal, what are the criteria that you look for as you're a passive investor? What's the key 3 or 4 things that you really look for that are critical when you're evaluating a deal?
That's a great question, because my mom she's a very active passive. So she's passive, but she goes to all the events, all the meetups. She looks at deals in depth. She's on the phone with sponsors. And it's because she has a very specific set of criteria that she looks for in a deal. And also she says it's really important to at least have a baseline understanding of a syndication so that you know exactly what's happening, what the underwriting terms mean, et cetera. So I would say that what I look for and what she looks for is very different because it also depends on the phase of life that you're in. My mom is looking to replace income because she's retired, right? So that's very different to what I'm looking for because I'm not retired. I have a 9 to 5. I'm a realtor in Dallas. So I don't really necessarily need the cash on cash
Mhm.
element is not as important to me. So my mom looks for high cash on cash and high depreciation. Depreciation is, what we use to offset our tax liability. My mom is a real estate professional, so fortunately, she can also use that to offset her ordinary income as well. Though at this point they're retired, so their only income is multifamily. So anyway, so she looks for high depreciation benefit and high cash on cash. I look more for the multiplier. So I'm looking at,
Mm.
what kind of X is my money going to do in 5-ish years. So I think, at least I know the deals that we look at, it's like 2X is bottom. Like I need something to at least project conservatively 2X in 5 years, like 100% return in 5 years. And then cash on cash is a great cherry on top, not necessarily very important to me. I'd rather trade cash on cash for a higher like equity multiplier. Not that they're like in, reverse sort of conjunction or anything like that. You can have high cash on cash and a high return. But I would say that's much more important for me. And then I also look for sponsor track record, right? Like when I'm passively investing in a deal, Mark Kenny, who obviously we both know and work with, he said something at a conference I went to that was so good. And he said, if you ask a sponsor, you know, have you had a deal blow up in your face? Like, what's the worst thing that happened? If they say that everything's always gone perfectly, they've never had a deal blow up, never had anything bad happen, they either haven't been doing it long enough or they're lying. And both are bad. So I think it's really important that, you vet your sponsor and that like they're not perfect, of course, but you do want the track record to show a history of success, right? And then for them to be honest about the shortcomings maybe they've had and lessons that they've learned along the way.
Exactly. Transparency. Anything else you want to add
Yes.
to that, Dylan, in terms of what you guys look for when you're investing?
Yeah, I think I mean, you definitely touched on pretty much everything. I think another thing too, though, is like definitely the geography of the area is important.
Mhm.
Whether it's a primary, secondary, tertiary market. And I think sometimes people get like really intrigued by a certain area, like, oh, that's a really nice city. Like, oh, there's a lot of fun things to do there. Doesn't necessarily mean it's a great place to invest either. So I think those are things that, you got to be really specific with and make sure that you're not just investing because of the name of it, or the you want to. There's a lot more involved as far
Yes.
as like industry and things like that you need to consider versus like, oh, I would go have a birthday party there or something like that.
Which is why everyone should attend the webinars. Like if
Yes.
your sponsor
Yes.
is hosting a webinar, attend it. If you attend it
Totally.
live, generally there's a Q&A at the end where you can ask questions. But
Mhm.
at least all the sponsors webinars I've attended definitely go over everything that
Yeah,
Dylan just said,
definitely.
jobs and all that
Right.
kind of stuff.
Yeah, back to your mom's criteria. That was a really good answer, Rachel, because your criteria is different than your mom based on where she's at in life. Like same thing
Mhm.
with me. My strategy is probably different than yours when I'm investing. That's a really good point. It's the old, I'm going to say Socrates, know thyself.
Yeah.
Nothing in excess.
Right.
Know thyself, know yourself before, because not all deals are great for you. They may be great deals, but they may not fit your needs. Like I've got people that want to invest, but well, my kid's going to go off to college in 4 years. Well, you don't want to put it in multifamily because that money is going to be tied up 5 to 6 years potentially. So, that excludes them from this just isn't a good fit for you. And that's fine.
Yeah.
Eventually I'm sure they'll work with me, but that's really important to know that everybody's different. You just can't say,
Mhm.
I'm going to copy this criteria. It's got to be really what's best for you. And
Right.
then let's talk a little bit about the markets. Like you said, I think the real estate guys are the famous ones that quote, live where you want to live, but invest where it makes sense. And I have that
Yeah.
problem I live in Michigan, but we own properties in Texas, Florida, and Tennessee, and all over. Like, oh, they want to invest locally. Well, that's not really the best place. Michigan's got a negative population growth. I love it here, but it's really not the best place to buy a multifamily. So what markets do you guys like that you feel are pretty good based on your criteria that you really say, hey, these are the markets we like to play in?
Yeah, I mean, I think, the South obviously is notorious for being a really great place to invest for the most part, primarily because, I mean, it is changing, but primarily because the returns are a lot greater than anywhere else in the United States. It's a lot lower cost for a purchase price, which helps the return. There's a lot of variables that certainly make it a positive, and not to say, you can't invest, you can invest in other areas of the US, it just might not be as fruitful, or, it might be going back to, where you are in your life. It might be just a different type of return. You might be getting other benefits from it. Maybe there's better tax benefits than money that, return that you get back from cash flow and things like that. So definitely, yeah, I think the South, Texas obviously is always a great place. Florida is a great place. Alabama and Georgia are always really, really lucrative. So it's kind of like this weird, I guess it's the Sun Belt technically. It's this weird little sliver, and then it kind of just shaves off. But yeah, really love those areas. But, Ohio's becoming a really great place. It has for the past 5 years to invest in, very, very, definitely some great returns you can have there. And, a lot of syndicators in multifamily, they have like what are called ozone areas, and those are great for tax benefits as well. So it's just what kind of play you're looking for, whether it's a lot of cash up front, or whether you're just looking to offset some of your ordinary income.
Good point. Yeah. Anything you want to add to that, Rachel?
Yeah, no, I think like he hit all of the points. It's where people are moving to, right? Where are they moving? Where's the industry? What is a landlord friendly state? And then also, like he said, there's other incentives that maybe aren't as obvious, like the opportunity zones, or there's like a pilot program in Tennessee, which I know a lot. You've had properties in Memphis, and it's like some good like tax advantages. So I think there's different merits to different markets. Just, make sure that you do your preliminary research, and that, your sponsor's done their research as well.
And that's the beauty of the internet. Everything's Googleable. It really is. So you can check the crime rate, you can check whatever. So I always recommend investors, like, take a look at it. Certainly we're providing you the data, but you can verify everything that we share in our presentations, in our investor decks and all that. So that's a really good point. Do your own due diligence as well, because your money as well. So, so let's talk about deal sponsors. Like, what do you look for in a really good deal sponsor when you're going to passively invest into? What are the criteria used for those people?
Yeah, I think, again, track record is really important. I want to see that they've done a lot of deals, or they're partnered with someone who has done a lot of deals and had a lot of experience. And, that's experience is the great educator. So if you see someone that's done, in the tens of thousands of units, then that is awesome indicator that, they're going to be great managing partners. And then I love to get, an investor referral. I love to hear from someone who's invested with them passively, and, kind of see what they thought of their experience. Communication is huge, by the way. Communication is like number one. You want a sponsor who gets back to you as soon as possible, is transparent, Matt, like you were saying. Transparency is huge. You don't want them to beat around the bush, open book with the financials, with everything. This should be totally open to a passive investor, which is why people choose this asset over REITs. Because with a REIT, you don't get this kind of transparency. You don't know where your money goes, frankly. And that's the beauty of a syndication, is it's still completely passive like a REIT, but you actually own the real estate, which gives you the tax benefit. And then also you get a lot more control over which deals that you invest in, which gives you the opportunity to ask a lot of questions and be prudent about where you're putting your money.
I think also too, this is, I guess, again, maybe more philosophical or behavioral, but, I think people that that's not always the case, but I think people that could be your friend, maybe like that kind of personality, are also a great thing to look out for, because last thing you want is someone who's like really pushy all the time, or just really rude, like what's the point in investing with people like that, because they're going to most likely make some bad choices down the road as well, because of just who they are as a person and how they go about life,
And you got to deal with them for the next 5 years.
Yeah, exactly.
Yeah, that's the thing. You're married to them for 5 to 6 years. So you want to make sure, do you like their communication mode? Do you like, the frequency? Are they transparent? Are they following up quickly? And that's the worst things. I think I've invested a lot of passive deals, not 20, but probably 15 or so.
Wow.
And I learned more from the bad general partners than the good ones. Because those are the
Yeah.
ones, I'll never do that to my investor. I will never leave them hanging. I'll never send them a document, let them figure out how to fill it out,
Yeah.
and things have changed quite a bit now. We have DocuSign and all that. But I just remember the day when I first started that nobody really did hold my hand that much. And so I'm super, and I know you guys are as well, super empathetic because you've done it. You know what it's like. You remember what it feels like. So I think that's a really good point. You're tied to that person for a long period of time, and use your gut. I'm a vibe person. If you
Yeah.
don't have a good vibe, walk away. You don't have to. There's lots of other opportunities out there. I love that. That's a really
Exactly.
good message. Good message.
Yeah,
Good
totally.
message.
Totally.
And Matt, you
So,
have a great vibe.
oh well, thank you. Well, we're pretty close friends, so we vibe pretty well. That's why
We do.
we work together on stuff
Yeah,
because
exactly.
we
Sure.
vibed immediately.
Yeah.
So has there been anything that I've shared before my horror stories of investing, and actually as a general partner, I had one that had a capital call. I put $100,000 into a deal, another deal during COVID. So I've had my Mark Kinney, I've had my challenges and we've overcome them. Some opportunity costs there lost, but not a ton of money, fortunately. So is there
Mhm.
anything that you guys have run across, any challenges you've personally experienced or you've seen in other deals that you could kind of tip off new investors to look out for?
Yeah. Student housing. Don't do it.
Very good.
Don't do student housing. Yeah, don't. There was a deal in Waco that I was a passive investor in, and it was a Baylor, it was owned by the University of Baylor, and it was student housing, and the syndicator that was syndicating it is like so amazing, and all of his deals have been total ballparks, like just an awesome guy. So it wasn't an operator problem at all. It was just a bad investment. We just took a flyer on student housing and it was just awful. I mean, they don't take care of the place. It's very cyclical, right? It's hard to, you don't get, tenants resigning because they're just students. They're gone for the summers. I mean, it was just bad news. So bad news
Thanks for
bears.
sharing that. Thanks for sharing that.
Hopefully someone got that joke.
I think that, I think, I mean, there's always a risk with this, type of investing, of course, but going back to, as long as you're with a good actor on it, on the deal, I think, you're in good hands for the most part. So there's always, things can always go wrong, but I don't think that should deter anyone from wanting to try it out and see what it's like. And, I guarantee if someone gives a shot, we tell it to our investors all the time. I say, look, I understand it's a lot of money that's you're investing in, and we've been there before. It's scary at first, but after the first cycle of a deal, you are suddenly addicted, and there's no rehab out there for you. So
That's true. That's true. Once you can realize that, oh my gosh, I just did 2x our money. And I
yeah,
know it's been uncommon times that we're doing deals 2xing in 24 months or 36 months. Now, I don't know if
right.
that's going to continue, probably not. But when you see something like that, you can't experience that in Wall Street or pretty much anything else that isn't super, super speculative. That is, this is backed, one of the best risk adjusted investments. It's backed by real estate, a physical asset. It's not a
Yeah.
paper stock you're holding or a REIT, which is just another piece of paper. It is an actual physical collateral item that's insured. So if something goes wrong, you've got covered for lost income and all sorts of stuff. I mean, it's like you said, Rachel, Wall Street spends billions of dollars advertising this, but nobody advertises, syndications or passively investing in real estate like this. So that's it's great that we're out here putting the word out there. There's other options, people. You
Yeah.
just don't know about it because no one's paid a lot of money to share that information.
Right, exactly.
Absolutely.
And the risk is mitigated, right? We carry comprehensive, I know you do too, comprehensive coverage on all of the investments because frankly, the lender requires us to. So it's like you don't have insurance on your stocks, It's
Oh,
like if the fire hits the stock market, it's tanking. And if a fire hits our building, we're just making a claim. So
exactly.
it's a little bit different.
Exactly. This is some good benefits. Is there any good projects you're working on right now? Anything you want to share with us that you guys are working on? What's your focus right now in multifamily?
Yeah, we are working on some development projects that are super embryonic. I wish I could share more, but I'm super excited about them. There's so many things that can happen with development. So, I mean, we haven't even approached the investor level yet. Like we're still just working out with stuff with the city because, the city can put a kibosh on it in a second. you know, there could be a soil problem. Like there's just all these different weird things that can happen with development. So super embryonic, but my fingers are crossed. That'd be a fantastic deal to get rolling on. And then, yeah, we have a couple other raises going on for various multifamily asset classes in Georgia and Arizona right now. Yeah, and then what else? Just some
We're also, I mean, we're
oh,
also
the commercial
learning.
real estate fund too.
Yeah, yeah, of course. We're also learning a lot of, trying to branch out and just, even if we don't invest in other sectors of passive investments, at least learn about them, like
Mhm.
carbon capturing, for example. I mean, it's like super fascinating. ATMs. I mean, there's so much out there. It's kind of, it seems like it's an endless book of ideas, as far as that goes.
Oh yeah,
That's true.
totally. But multifamily's our fave.
Yeah.
Mine too. I mean, I invest in tons of other things, but the majority of my holdings, the same thing, are multifamily because it's the most stable, it's most
Yeah.
predictive, if you all. Everybody needs a place to live, and when the
Yeah.
economy goes bad, more people unfortunately move into apartments, and so I think it's a pretty safe bet. But yes, that's good, and it's good
Yes.
to be aware of those other opportunities out there because maybe you do want to pivot at some point, or at least do some more diversifications. Excellent,
sure.
excellent.
Yeah.
Well, this has been good information here. Now we're going to move to the rapid fire 5. In my right
All right.
hand, I have some questions here for you. These are just fun questions to get to know you a little bit better.
Okay.
So I'll let each of you answer the question. Rachel, you go first, and then Dylan. The number one, what was your nickname as a child?
Oh, wait, for my family or from like school?
Just whatever.
Oh,
Plural.
okay.
You can share both if you'd like.
My grandma called me Jitterbug. And then when I went, so I was homeschooled till high school. And then when I was in high school, it was Finn. Because my maiden name's Finninger. But anyway.
Dylan?
Mine is pretty boring. It was just Dill. So yeah, no great story. I mean, I had plenty of other, names that, my friends called me jokingly, but I won't share those. But yeah, Dill was the primary one. And now Rachel calls me Mac. Don't know where it came from.
It just
but
evolves.
yeah.
Yeah, totally.
It's the mustache. I think it's the mustachio thing going on there. He looks like a Mac from 1972.
I'm a Mac. That's right. Yeah.
Number 2, morning person or night owl?
Oh, morning. Because
Dylan?
there's coffee.
That's tough. Yeah, because I definitely fluctuate. But I'm gonna go with morning also. Lately,
Everybody's a natural tendency, so yours both morning. What's as good?
Yeah, I think so. Yeah.
You're on the
Well,
same
I think
we go to bed at midnight and we wake up at 7, so it's kind of both.
Well, not since we had our baby. Yeah. So now we're like in bed by 10 and not by 7.
Yeah.
So,
And something in between with Willow? Is there something in between? Usually you have to get up in the middle of the night?
She sleeps straight through.
What?
We're so lucky. Yeah,
Going-
totally. 7 to 7. Yeah.
Well, this next question applies because you've already won it. So what would the first thing you do if you won the lottery? Well, first off, you won the lottery with Willow. She sleeps through the night at that age. Phenomenal. So you've already won. Okay, this is monetary. What would you do if you won the lottery monetarily?
I would buy a super nice ranch in the Ozarks and have horses and a truck and a trailer and just all the like really nice horse things because that's like my dream. Yeah.
I would come visit you.
Yes. And oh my gosh, and I'd have a guest house for Matt for sure.
Excellent.
I would probably well, since Rachel would do that, I would probably just, and this is gonna sound like really goody two shoes, but I would probably put $100 in every person's mailbox in Dallas.
That is
Just drive around, pop it in, and because
right.
What's your real answer?
that is my real answer.
Dylan's like
He's
the
paying it
nicest guy
forward.
ever.
He's paying it forward. What a great guy. Okay, number 4. If you could live anywhere in the world, where would it be?
Well,
we really love Tokyo.
yeah, I know. I
Really?
was gonna say Tokyo, but I just said the Ozarks, which is like
Well, I
totally
know you
different.
have a second option. This is your second home. Where would that be?
Tokyo. It'd be Tokyo,
Yeah.
Japan
Really?
for sure.
Tokyo.
Love it.
Yeah.
Love it. It's
Japan
so
is
incredible.
It's so clean. The people are so nice. It's so affordable. The food is fantastic. Like we went for like a couple weeks a few years ago. It was amazing. And like it has beaches. It has like this island on the south coast, which looks like the Hawaii or the Maldives or something. It has the mountains, skiing. It has like every type of topography you'd want. It's fantastic.
Yeah, it's pretty cool. And as a volcano, what better way to die? So
What better way to die? Yeah. Love it. We'll die there. That's what we'll do.
That's right. Yeah.
Yeah, that took a turn for the worse there. Okay, we're gonna move on. Number 5, the last question is, one piece of advice that you would give to new investors to help them get better returns. It's the one golden nugget you would give.
Ooh, to help them get better returns. I would say just do it.
Yeah.
Because I think the
Actions.
biggest regret, I ask investors what their biggest regret is, and it's always that they didn't start earlier. The perfect time to invest was 10 years ago. The second best time is right now. And I
Very
think
good.
to get better returns, you really just got to commit. Just do it. Just do it. Don't overthink it. I mean, of course, do your due diligence. But if you're just putting in like 10K here, 10K there, you're not going to get great returns. That's not going to move the needle. You're going to be like, oh, this multifamily thing isn't so. Well, yeah, because you barely put any skin in the game. So I that would be my best advice, would be just do it.
But if that's all you have, then you should definitely invest it if you can. I think people do wait because they wait to have the right amount of money, which I know sounds like a crazy concept, but if you can get 10 of your friends to all pitch in $5,000 and invest it together, then you're at least starting with something. Otherwise, you're going to never.
I mean, it's relative. Yeah, it's relative.
Right. But
I agree with what you're saying.
Action. Yeah.
Take action.
Exactly.
Yeah, totally.
Definitely. Yeah. No, I
even if it's a little scary. What's your advice?
that's my advice.
Is a
It's the
pool
same
of
thing?
resources,
Yeah.
which is good because I've
Yeah.
had investors say, hey, you know what? It's $100,000 minimum. Can I get 3 people to come in? That's fine. You've got to come in as
Yeah.
one individual, but you guys can
Right.
do stuff behind the scenes. That's fine. And so we've had lots of investors. I think we had 5 people bringing in a
Yeah.
chunk of money a few years ago on one deal. They came in as one investor. So that's a really good tip that I don't think to promote or anything, but
Yeah.
Dylan.
Well, because it's I think it's scary, even if like the whole being afraid thing too. It's like, okay, well, if you don't want to invest a full 50, 75,000, whatever it is, at least maybe get people together and then you can all be afraid together and do it, or something.
Yeah, and it minimizes your risk, but you get
exactly.
the big reward because you're getting into those opportunities.
Right. Exactly.
Outstanding advice. It's just been an absolute pleasure having you two on the show. Before we end, tell us how people can reach you.
Yeah. So our company is called Third Coast Capital. So you can head over to our website, which is thirdcoast-capital.com. And third is spelled out THIRD. And then you can reach me, Rachel, at thirdcoast-capital.com. And then Dylan's the same, but Dylan at. And then I also have a podcast.
I want you to plug your podcast. It's great. Go ahead.
Yeah, thank you. Yeah, so I have a podcast with one of my other business partners, Andrea, and it's called Good Investing. It's on iTunes, not iTunes, Apple Podcasts, Google Podcasts, Spotify, YouTube, like all the regular suspects. And go check it out. It's just education. That's all. Education for passive investors.
It's very good. I'm a fan of the show. So yes.
Oh, thanks, Matt.
Fun.
Likewise.
Well,
Yeah.
Thank you both for being on the show. We greatly appreciate you. Dropped some really good nuggets of knowledge here for the listener. I do appreciate you both. Take care.
Likewise.
Thanks, Matt.
Take care.
And that's a wrap. Thank you for listening to Better Returns, brought to you by Hanson Holdings. If you enjoyed this episode, please leave a 5-star review because it helps others discover this valuable content. If you would like to earn truly hands-off passive income, go to hansonholdings.com, where we help you invest in large apartment complexes to grow your family's wealth. See you next week with another awesome episode. Have a great day.